Hello, and welcome to Portfolio Matters, weekly markets checklist, week 206. But before we get into it, Richard will read the disclaimer.
Thank you, Keith. Everything discussed during the Portfolio Matters podcast is for informational purposes only and should not be considered as investment advice. Listeners should be aware that we will be discussing securities that we own or have a financial interest in. Please do your own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. A full disclaimer can be found at the end. What do we have this week, Keith?
Lots going on in the world, but before we get going, a bit of housekeeping. We're going to do another one next week, because then I'm away hiking for a bit. And also, I'm working hard on the copper presentation, which I hope to spin out as a separate podcast, possibly next week as well. We'll see what Richard's schedule is. But first of all, the news. Well, lots going on. First of all, the US Supreme Court has ruled that President Trump overstepped his authority when he used the IEEPA, the International Emergency Economic Powers Act, to impose tariffs. They have deemed those tariffs unlawful, and anyone who paid them may now sue the government for a refund, potentially meaning that the government is liable for 175 billion of tariff rebates. Donald Trump has promised to oppose those rebates, and it's likely they will take 2 to 5 years of litigation. He then moved swiftly to enact new tariffs, which he initially said would be 10%, then he raised to 15% before actually enacting 10%. So chaos continues. Those tariffs have been enacted under Section 122 of the US Trade Act, and he can do that for 150 days before he needs the approval of Congress. Elsewhere, researchers at ASML have found a way to boost the power of the light source they use for their extreme ultraviolet lithography machines, which means that they can increase chip output by about 50%. So that's good news. And the big backdrop at the moment is tensions in the Middle East and will the US attack Iran? So far, they haven't. But there's been a big build-up of US military forces. So the US Supreme Court struck down Donald Trump's tariffs under the IEEPA. He was not happy. But Donald Trump can impose tariffs without going to Congress by 5 other legal routes. Tables here, pause, take a look. But all of them impose much more restrictions on the scope and scale of the tariffs. So going via the IEPA, which has now been struck down, he could do whatever he liked. But now, his going under the US Trade Act, for example, means he can only impose them for 150 days. The net effect of replacing his original tariffs with 15% tariffs is shown in this chart. He's actually imposed 10% tariffs with the promise he's going to raise them to 15% in the future. But the net effect has been to reduce the tariff rate. And the big winners are Brazil, China, and India. The big loser is us.
Oh dear.
Yeah. And he's potentially going to have to rebate 175 billion of tariff revenue, and that will be bad for the US deficit. Um,
What a
yeah,
mess, though. What an administrative mess as well.
absolutely. It's going to be a huge mess. And unsurprisingly, the number of lawsuits surrounding tariffs has shot through the roof, and this will only get higher. A bonanza for lawyers. But the US is got a huge buildup of military assets surrounding Iran. which are enough to execute a multi-day aerial bombing campaign, but are not a land war. And the danger is having invested in moving all these military assets towards Iran, that Trump will feel obliged to use them. The World Uncertainty Index is at an all-time high. On to economic news. So UK inflation came in soft, hurrah, at 3.0% in January. Core was at 3.1. The UK unemployment rate, however, rose to a new high for this cycle at 5.2% in December. But according to the ONS numbers, UK employment rose by 52,000 in the 3 months to December. How does that work? HMRC payrolls, however, continued to decline, which seems more in keeping with the unemployment rate rising. UK productivity growth was a shocking minus 0.6% quarter on quarter in Q4. Not good. But the PSBR beat expectations. Hurrah in January. We had a record surplus in January. Turning to the EU, GDP growth was 1.3% in 2025, beating the UK, which had 1.0%. The PMIs were weakly positive but improving. US Q4 GDP came in very soft at 1.4% annualized, but that was due to a negative contribution from government spending as a result of the October shutdown. The underlying economy remains much stronger. US inflation came in soft at 2.4% year on year. Core was at 2.5%. Industrial production beat expectations at 2.3% year on year. That's good. The PMIs were weakly positive but weakening. Now, the big market event of the last couple of weeks was that the rotation out of software continues, and AI is clearly having an impact on jobs in sectors exposed to it. More on that coming up. Turning to market news, well, Nvidia beat expectations. Turning to market news, Nvidia beat forecasts and forecast revenue of 78 billion for the current quarter, surpassing our expectations of 72. It had profits of 120 billion last year, but sign of the times, the market reaction was muted. The market seems to be growing more skeptical about AI in general, and the rotation has been out of tech into commodity and hard assets. A Citrini Research substack post about the potential impact of AI on software companies and the wider economy caused an accelerated sell-off in software companies. And the software company index is now down a third in 3 months. We've got some discussion of that later. And Blue Owl Capital permanently halted investor redemptions at one of its private credit funds. Now, that's interesting. This is the same sort of mechanism that we had in the lead up to the GFC, where there is a mismatch between the liquidity of the underlying and the liquidity promised to investors. And so investors have attempted to get their money out of this credit fund, and Blue Owl have shut the gates. So it will now take them between 2 and 5 years to actually get their money back. And historically, when this has happened, it has led to an accelerated sell-off in similar funds. Finally, AMD shares have surged, actually not that much, after they announced a multi-billion-dollar chip deal with Meta, which could lead to Meta purchasing 10% of the company. So this is Nvidia. Revenues up an astonishing 73% year on year. Earnings up almost 100%. But it's also revealed that its forward purchase obligations were 95.2 billion, up from 16.1 billion last year, because TSMC, who make all its chips, have demanded longer term contracts and more cash up front. Frankly, given that it makes that pretty much in a quarter, that doesn't seem that much of a problem to me. But as a sign of the times, the market reaction to the bumper earnings was rather muted. Now, markets are very concerned about the impact of AI, and the fact that this Substack post caused a huge sell-off in software stocks, I think, is more a sign that the market is jittery about the valuations of these software stocks than that they believed the doomsday scenario painted by the Citrini Research. IBM had its largest share price fall in 25 years. This is Blue Owl Capital, not great. Shares of what's that, halved in the past year. AMD, yeah, the news I read said its share price had surged 15%. Well, that's not 15%, frankly. And they are well down from their peaks in October. But the story of the last few weeks, in fact, the start of the year, is a huge rotation out of tech and into hard asset stocks. So commodities of all kinds. We've talked previously about copper, silver, oil, but the move has been absolutely astonishing. Energy and materials are leading the way. Great news for Richard and for me, actually.
Good.
Tech is down on the year. So let's talk about this piece by Citrini Research that caused this sell-off in software. So essentially, it was a sort of dystopian fantasy where they were talking about how agentic AI systems will rapidly substitute electricity for human intelligence and lead to massive white-collar job losses. And that will raise labor productivity. But consumer spending, what they're saying is consumer spending will fall as laid-off workers lose purchasing power. And that will then create this sort of AI, human intelligence displacement doom loop. So company revenues fall, their profits come under pressure, so they reduce headcounts by substituting people for AI. And that leads to unemployment rises, an aggregate loss in the economy's purchasing power, leading to further revenue losses for these companies, leading to further job losses, etc. Repeat. And they coined the term ghost GDP to describe rising output that does not increase consumer spending and therefore weakens the health of the economy. So they're then forecasting deep recession, falling stock market, doom. What I'd say is there's no such thing as ghost GDP. You can calculate GDP either the revenue method or the income method. It's a measure of how much cash is circulating through the economy, and everyone, Nvidia's expenditure or the software company's expenditure is somebody else's income. So higher GDP equals higher income for somebody. And if GDP continues to rise as unemployment rises, then companies are making more money, and they will then be spending that on either more investment, which is like money to other companies, and dividends and share buybacks, returning those profits to consumers. So some consumers are making more money, and the net effect of this will not be a loss of aggregate demand unless those consumers who are making more money choose not to spend it. Now, sadly, I think that's probably likely to be true, because what you're doing is you're taking money away from workers and you're giving it to investors. So,
Well, just to
um,
chip in there, Keith, that's predicated on the assumption that the fundamentals of the Citrini research are correct. And in my view, they're not. The fundamentals are not correct. Never
Yeah.
mind the economic argument. So, I mean, my comment was this is a work of science fiction, and I believe it is a work of science fiction. It's economically wrong, and technically it won't happen.
So, Richard, could you expand on that? Because you sent a video through, didn't you? Which I watched. You did.
Yeah. So basically, excuse me, the Citrini research is predicated upon AI being able to undertake all of the functions that computer programmers and managers and so forth can currently do. So it displaces all of those people. And if you do a bit of research into what AI can actually do at the moment, including what it can do in terms of programming, it simply isn't capable of doing those things now. And Citrini Research is talking about, is it 2027?
Yeah.
Which is a year and a bit's time, and AI simply can't do that. So Anthropic said that they created a C compiler. Well, they didn't create a C compiler. They created something which was a C compiler, but AI didn't create it. Excuse me. And then also, it's predicated upon AI being able to reason. Because if you're going to actually take on a whole chain of activities that humans currently undertake in an organization, it needs to be able to reason. Well, it can't reason. It's an engine. It's a statistical engine. It's a clever statistical engine, but it doesn't reason. And there's a lot of very clever people who explain much better than I can why it is that it is not reasoning. It is simply putting together what it considers to be the most likely answer on the basis of historic information that it has. So, it's just at present, it simply isn't going to happen. Now, I'm not saying that it won't displace some jobs in some areas, but I think it's extremely difficult to say what they'll be, when that'll happen, and to what extent it'll happen. And certainly to come out with this sort of thing, I mean, it basically, in my view, is an advertising gimmick. It must have done wonders for Citrini in terms of their publicity, but it's not in any sense, in any way, realistic.
Actually, on the when you say it's correlation engine, so I was listening to something that was talking about AI hallucinations, and it's saying that hallucinations are inevitable and probably unavoidable for these large language models because they're simply guessing at the correlation
Yeah.
and they get it wrong.
So they take the context. They take the last however many. If it's a verbal question, or a text question, they take the last however many characters or words in that string, however many they look at, it might be hundreds, and then predict what the most likely next word is. And they don't. But there's a very interesting. That's a very interesting video given by a guy who's a visiting fellow at Cambridge who describes the information content and actually the technicalities of information content. And one of the things he says is if you start, because one of the things that the AI companies talk about is using, because there's now, they've run out of training data, use AI to train AI. In other words, use AI to create the training data. So you get a recursive problem of effectively the hallucinations you referred to effectively start to creep in gradually. And as you train and train and train, hallucinations become exponentially more important as you do this recursively until ultimately you get gibberish.
Yeah.
So I just think that this is...
What I would say, Richard, is that the software companies are going to come under a lot of pressure. And because we've seen it in some of the companies we invest in, that it is possible to use Lovable and these companies that allow you to vibe code to make your own software. And so when it comes to the subscription renegotiations every year, software companies are going to find their pricing power is really reduced. And I would expect their share prices and their revenues to come under a lot of pressure.
Yeah, I mean, I think that's probably true, Keith. I think that it can code relatively straightforward things reasonably well.
Mm,
I don't think that it can code complex things at all. And I also, the coding is basically it's underwritten, so it's very very cheap to vibe code,
yeah.
um, the, and the cost is effectively underwritten by the VC that's investing in these companies. When the companies actually have to make a return on investment, the cost of the coding using AI will go up many fold.
Yes.
At which point, obviously, being technology, it will get cheaper. But at which point, I think you run into the question: well, which becomes cheaper then? Is it, or at least from an economic point of view, this sort of effectively free programming that is currently available will
Mm,
vanish, and it will no longer be
yes.
free. And so, I think that there's definitely an issue there that nobody's talking about.
Well, on that point, Richard, I think the big problem for all these AI companies is that essentially they have no moat. Everyone is doing the same thing. All the technology is available
Yeah.
to whatever company wants to set up their own large language model, particularly the Chinese. Now, we are awaiting DeepSeek 4.0, but I hear that it is of comparable performance with the latest ChatGPT and Anthropic models, and they're going to price it at about 5% of the price of the others. And so you
Right.
just don't have any pricing power. And if you try and raise your prices, on your point, if you try and raise your prices, then the Chinese are going to massively undercut you.
Yeah, and if you don't raise your prices, you're reliant upon ever more investment capital going in that has ever less
Yeah.
chance of getting a return. And at some
Yeah.
point, and this is being talked about a lot, at some point, this funding cycle is going to fail, and the
Yes.
fallout will be well. Ask Grok what the fallout will be when it.
Yes. I don't think Grok will have the funding to actually produce an answer at that point.
Yes.
But anyway, currently USR unemployment is currently only 4.3% and it's falling. So, but Goldman Sachs calculate that industries most affected by AI are seeing consistent job losses. And one of the side effects of this will be a loss of white collar jobs. And what industries will those people get jobs in?
I I think I sort of agree that it's possible, but I'm not sure that we've really got to the bottom of it yet. And I suspect there may be a sort of cycle where people say, yeah, we could get rid of all these people. They
Yeah.
get rid of all these people, and then they suddenly find that AI can't do the job and they have to re-employ them. I wouldn't be surprised if something like that happens.
Well, I really hope so, Richard, because I really hope that customer service will massively improve as we actually get some people back.
I had the most appalling um, interaction yesterday with the Lloyd's Bank um, telephone menu before you get to
Yeah.
speak to anybody. And it was, you know, it's been bad for many years. It was dreadful.
Yeah.
It was utterly appalling. And
I
then
know.
then I made the mistake of, I said, yes, I'll do the customer questionnaire at the end, please, because then I could explain how terrible it was. But of course, it doesn't actually allow you to comment on the thing you want to comment on, and it simply asks you this irrelevant question about my call with Lloyd's Bank. And I said, the question's not relevant, and it said, I don't understand your answer, please. The question's not relevant.
Yeah.
And,
Yeah.
then I hung up.
Yeah. I know.
It's like, how can you design something so bad?
Well, sadly, I had a very similar experience with Barclays. So I was wanting to block a payment and I just couldn't do it. I went round and round in circles. And it seemed like the telephone system was designed to keep you away from talking to somebody.
Precisely, that's what it is, isn't it?
Yeah.
Yeah, and the I want to speak to somebody. I mean, in the end, I said I want to speak to someone about 15 times, and it finally said, "Would you like to speak to somebody?"
Yeah.
Dreadful.
Yes. Um, so job openings for white collar work, finance and insurance, professional business services, all going down. Not great.
Mm-hmm.
And software companies, basically supply of software is going through the roof. That's what this chart shows. Everyone is vibe coding. So supply is increasing. I'm afraid prices are going to come
Yeah.
right down. But this is actually news this morning. So we're, obviously we're skeptical about, Citrini Research, but then Block, Jack Dorsey's latest company, which its brands include Square and various payment systems, etc. It's cutting its headcount from 10,000 to 6,000, citing AI efficiency gains. Now, that may be an excuse, but, you know, this is real. Tech companies are cutting jobs. So, our thoughts are chip in, Richard. So, AI layoffs are definitely real. We think that software companies will not disappear, but their bargaining power will fall, as will their profit margins. That means their share prices are going to come right down.
Yeah.
And there's going to be a lot of uncertainty about that.
Yeah.
The net effect of AI layoffs will be reduced demand because I think that workers have a higher marginal propensity to spend than do investors. But also I think there's going to be a lot of political pressure as unemployment rises, particularly from amongst white collar workers who are vocal. Higher corporation taxes, higher dividend taxes, specific AI taxes. What are your thoughts, Richard?
Well, I guess if you if you if you assume that AI is going to pressurize, particularly pressurize jobs in general, particularly jobs that follow rules. Um, you do start to move towards whether some sort of universal basic. I mean, under the Citrini scenario, and people know
Yeah.
what I think of that now. You move to having to have a UBI, you don't need universal basic income because it's the only way that the economy or people can survive. And I mean, I think the effects will ultimately be quite dramatic, but I think it'll be over quite a long period of time.
Yeah.
I think there's an awful lot of shakeout that has to happen in terms of where we are. I also think, there's this. Sorry, it's slightly rambling, but some of this stuff is predicated upon having artificial general intelligence. But I think the general view of people who are in the AI sector is that AI industry is that LLMs will never create artificial general intelligence. They're not
Mm.
that
Yeah.
structure, and so I think it's very good at following rules, isn't it? So you can see that if legal work is all rules based, it'd be very good at that. Simple software coding is rules based, should be reasonably good at that. I think the issue will come where actually you require judgment and reasoning ability, and it can't reason. It doesn't reason.
Yeah.
So I think the effects will be quite partial. And I think actually basically people are thinking AI is going to be all things to all men, and they are reacting accordingly, and it's not going to be.
Yeah. Yeah. But what I would say is don't go bottom fishing in software stocks.
God, no. I
Yeah.
mean, one of the things that strikes me about it is we've talked about the ridiculous valuations of these software stocks during COVID,
Yeah.
all
Yeah.
those years ago. And actually, many of these valuations, I mean, they dropped by a third, but if you go back 3 months, many of these
Yeah.
valuations, they were equally ridiculous. and actually still are ridiculous. So it's a little bit like the bubble is being let out of the balloon in a way that isn't causing a crash, which is good, I think, but which is definitely causing a sector rotation. What's that? Is it Halo? Is it hard asset? Something or other. There's a new investment style.
Yes, that's right. Above all, there's a lot of uncertainty about the future value of software stocks. So essentially, people are rushing into hard assets as safe haven. And onto equities, Richard. Very
Halo
good.
stands for heavy asset low obsolescence, i.e., car manufacturing or something like that.
Yeah,
Steel production.
I'll avoid that as well. Anyway.
Yes. Thank you, Keith. Is this a weekly or fortnightly change?
Fortnightly.
Yeah. Thank you, Keith. So the weekly change is actually a fortnightly change. So the indexes for the last fortnight, generally speaking, have had a decent run. So the FTSE All World up 1.6, the FTSE All Share up 4%, Stocks Europe up 2.3%, the S&P up 1%. Russell, although the S&P is only up 0.9% year to date, Russell 2000 up 2.3, Nasdaq up 1.2, although down 1.6 year to date. I'm surprised in some sense it's not a bit more than that, actually.
Yeah.
Hang Seng up 0.5%, the Topix up 3%, and 15% year to date. So that's definitely the standout winner. Bitcoin up 2%, but down 23% for the year. Pound down 1%, but unchanged on the year. Euro down 0.4%, and the dollar index up 0.7%, but very slightly down on the year, with the VIX dropping 10.6%.
Yeah, so a couple of things. The performance of the all share is really good, given that UK economic growth is awful. Once again, shows you that the stock market is not the economy. But also, you can see here the rotation out of tech into anything else, basically. So the Russell 2000's doing much better than the Nasdaq.
Completely, yeah. So there's the FTSE All World Equity Index.
Looks like it's just steadily marching higher.
Doesn't it? Yeah. The FTSE All Share.
Amazing.
The Euro Stoxx 600.
Yeah, also doing well.
S&P 500.
That really looks like it's sort of topping out.
Does, doesn't it? Yeah. There's Nasdaq, which is sort of slowly rolling over at the moment.
Yeah.
The Russell 2000. Hang Seng.
Yeah, again, that looks like it's sort of topped out.
And the Topix.
That looks good.
Yeah, marching steadily higher. Bitcoin. I know, interestingly, what's going to happen to Bitcoin, Keith? Prognosticate.
Lame and busted meme, as my children would say.
I think my bet is it's going down a long way.
Yeah.
I also I suspect the price is currently being manipulated by people who have a huge investment in it. The strategies of this world.
Yes. Well, they'll do their best. Yeah.
So there's the pound against the dollar, which is basically pretty much unchanged for the last umpteen months.
Yeah.
The euro against the dollar.
Same.
The dollar index, which currently, despite everybody's predictions, hasn't taken a bath. It may yet, but it hasn't done so.
Yeah.
The VIX, which is very low.
Astonishingly low. Just, we're now getting used to these incredibly low levels of volatility.
Yeah. And this is the share buybacks by the this is a Mag 5, isn't it, as it were, fell to a mere 12.6 billion in Q4, which is a 7-year low.
Yeah. So they're doing loads of capex, but that means they're also cutting their share buybacks.
Yeah. And they're doing capex in high obsolescence. The soft asset high obsolescence.
Yeah. Good point. So I thought this was a really interesting chart. And what this shows is the relative performance of stocks with high capex compared to the stocks with low capex. And so in the long term, you have these brief periods where, high capex stocks do well, but in the long term, the market really prefers companies with low capex and high returns to shareholders rather than high investment. So, warning about investing in the hyperscalers, basically.
So these hyperscalers um, are expected to use almost all of their free cash flow in 2026 on capital investment. And doesn't leave them very much margin for error, does it, Keith?
No.
It also, actually, I suspect it explains why Nvidia's share price didn't respond particularly well to their blowout earnings, because people worry not what's happening now, but what's going to happen next year.
Yeah.
And these things, they become, these GPUs, they become obsolete quite quickly. And you can't do anything with them, can you? I mean, I guess you and I could buy one and make ourselves a pretty decent PC out of it, but sort of commercially,
Well, they're
once
astonishingly
they're obsolete,
expensive.
yeah, and once they're obsolete, aren't they?
Yeah.
So this is a classic example. This looks like a buy to me, Keith.
Yeah. It's a software stock. What could go wrong?
So that's PayPal. Beyond Meat. Wow.
Oh,
I
isn't this
mean,
corking? My God.
gosh, what's it? So it's actually fallen by by what I can't 99.7% or something.
Yeah.
So shares of cybersecurity firms also being affected by the Claude AI model, which reputedly, I don't believe a lot of this stuff just because I'm cynical. And I
Yeah.
think they're trying so hard to pump their valuations. Reputedly
Yeah.
are now used to scan their code for security vulnerabilities.
Well, the headline I think is incredibly, yeah, but this is pattern recognition. They're good at this, Richard. And so if they can go through the code and find, a common security vulnerabilities, that's great.
Yeah. So my son's a software engineer, and he tells me that AI is fantastic for telling you how someone else's code works.
Right.
It's very
Yes.
good at saying this is what it does. This is where it
Yeah.
does this. This is where it does that. Because as you say, it's pattern recognition.
Yeah. So you could
But
feed somebody else's code into it
yeah,
and say, where are the security vulnerabilities?
yeah. Or how does it do this?
Yeah.
You know, what point is it doing X?
We're doomed.
And US software stocks, as Keith said earlier, lost about a third of their value in 3 months. Although, I mean, if you look at that, they're only back down to where they were 2 years ago.
I know. Yeah, absolutely. In my mind, this could go a long way lower.
And there we are. I mean, have they really decoupled from earnings expectations, or are earnings expectations not really believable?
Well, no, I think they are believable but I think the market's questioning how long they can go on for, which
But
is your yeah.
that was my yeah. I mean, there's no more money left, is there, to buy these bloody GPUs now? Because they've all spent everything they've got, and they've spent quite a lot more than they've got on.
Mm.
So a strong equity retail flows there. I don't know what they're buying. What are they buying, Keith?
Well, oil stocks. Hurrah.
Commodities generally, hopefully.
Yes, exactly.
They're buying low obsolescence and insiders record selling, but insiders of where?
Yeah, well, in video and places, I assume. If I was an insider in video, I'd be selling as fast as I possibly could. So I thought this was a really interesting chart. And what it shows in the light blue is the indexed forward consensus earnings of US newspaper companies. And the dark blue line is their return of the equities. And what it shows is the market anticipated the collapse in US newspaper earnings 5 years before they actually happened. So the market is really efficient. When it starts to trend down, get out. The
Yeah.
market knows something.
Yeah. Very good.
And okay, a quick mea culpa. So last week we talked about Bitcoin financialization, and Mr. C. Peckham got in touch to point out that although Bitcoin has been financialized, which means that there's a lot more supply of it, you could say the same about gold and silver and the degree of financialization of Bitcoin. So there's about 15 times more synthetic Bitcoins than there are real Bitcoins, is nowhere near as much as there is in gold and silver. So apparently there's about 100 times as much financialized gold in the world as there is real gold, and 250 times as much synthetic silver as there is real silver. And this has been, a constant theme of Richard's for years. And therefore, if you think that financialization undermines the scarcity argument for Bitcoin, then surely you should say the same for gold and silver.
Not at all.
There
Not
you
at
go.
all. Because I mean, it's true that how gold and silver has been highly financialized, but what's happening now is people are saying, "Well, I don't really want the financial version because I don't trust the system.
Right.
I want the physical version," and that's the problem, isn't it? Because the physical version doesn't exist to the extent that people believe they own the stuff.
Yeah.
So there's a short squeeze, and there's this short squeeze is ongoing, and we're going to be ongoing for, I don't know, a long time, I suspect. And whereas with Bitcoin, I mean, Bitcoin is just a gambling device, isn't it? I know there are big people out there who will loathe me for saying that, but basically, Bitcoin is not a store of value. It's a way to try and get rich quick if you're lucky in your timing. Um,
Yeah.
it has no intrinsic value, but Bitcoin miners are moving to data centers because they operating data centers because they can't make any money out of mining. Well, that's a bit of an aside, and that's a bit of a hiding to nothing, if you ask me. But so I just think it's entirely different. I mean, the financialization of Bitcoin is the same process whereby the people who produce the financial products make a lot of money out
Mm.
of it. But Bitcoin, I don't believe, is ever going to go down the route of people saying, I don't want the ETF, I don't want the future, I want Bitcoin in my thing,
Mm.
and my wallet. I just don't think it's going to happen. So yes, as a sort of de facto, it's true, but I think the consequences are, well, the impact is going to be very different. Um,
Actually, while we talk about Bitcoin, one thing I've never quite understood is so Bitcoin miners, they earn Bitcoin for, basically verifying the system. But there is a limit to the total number of Bitcoins that can ever be in existence. So there are regular halvings of the amount of rate at which they get paid Bitcoin.
yeah,
But their costs are a function of energy. So if energy prices go up and the Bitcoin price fails to go up, then at some stage the whole system collapses because Bitcoin mining becomes unprofitable because they can't compensate you for the increase in the energy costs unless Bitcoin goes up at least the same rate or actually much faster. If Bitcoin goes down, at some
yeah.
stage the whole system falls apart.
I can't disagree with you, Keith. I don't know enough about the intimate details of it, but that sounds like it makes sense. And I think that it is. I think it's going to go down.
Yeah, lame and busted meme, as my children would say.
Yeah, yeah. I think it is. I think it's been a fun ride if you've been on it, which I haven't really.
Yeah. Okay, and on to commodities. So, quick summary. Energy generally strong. So, oil's had a good couple of weeks on tensions in the Middle East. US natural gas was a bit weak, but coal was also strong. Industrial metals strong. particularly neodymium and lithium, both of which were up loads. Lithium up another 20 odd percent. Precious metals bouncing back. Richard will be happy.
Hmm.
Now, I thought this was an interesting chart actually. So this is in the gold line is gold. The black line is equally weighted commodity index. And what it shows is the two actually are quite well correlated. So has gold decoupled or is it leading? Question. And on to energy. So Brent and WTI both had a good couple of weeks. Up strongly on the year, which is not what anyone was expecting, including me. Natural gas Dutch natural gas down a bit, but up 13% on the year. UK natural gas actually is decoupled from European gas, which is interesting. So up 3.5% over the past couple of weeks, but only up 5.3% on the year. US natural gas, not great. Fell 10% on the week, down 23% on the year. Dirt cheap again. More on that later. Coal, however, doing well, up 2.7%, 10% on the year. Uranium, bad couple of weeks, but up 8% on the year. So this is Brent. It's done well on tensions in the Middle East. WTI, similar. Numbers specific to the oil market. Well, actually, we've had net crude draws over the past couple of weeks. So that's interesting. US market undersupplied. Crude, pretty flat, but down 125,000 barrels a day since the start of the year in the US. So has US oil production peaked? Question mark. The Baker Hughes rig count continues to fade. So at this oil price, US oil companies not adding rigs. Now, before we get carried away by the rise in the oil price recently, Goldman Sachs are forecasting that the oil price will subside back towards $60 a barrel by Q4. So if geopolitical tensions ease, then the market remains oversupplied. But next year, they're expecting crude supply to actually fall. And from then on, I think the oil market gets tight. So if you buy now, well, the danger is that oil companies have had a good run. You could lose some money, but medium term, I think it's a good place to be. So I've been buying, done very well, just astonishingly well, actually, in the last couple of weeks. But I've got plenty of dry powder for when oil prices fall later in the year. Now, sanctions are working. So the average discount on Urals crude is now $30, which is an astonishing number, actually. So it's essentially what you're saying is Russia is getting half the market price pretty much, and it's all going to China because the US has put pressure on India to stop buying Russian oil. So the Chinese have stepped in. Now, one of the side effects of the Supreme Court ruling that Trump's tariffs are illegal means that he can't put as much pressure on countries such as India.
Mm.
You
That's
can't
true.
threaten them with like 50% tariffs. So I expect the Indians start buying again, frankly. But this is the bull case for oil in one chart. Super majors reserves have collapsed by a third in the last 10 years because oil prices have been very low and nobody's been investing. They need to rebuild them. And crude is the largest commodity market in the world by a margin. So when you see that commodity price index, actually the commodity price index was equally weighted, but the crude market is very important for the world economy. And when we talk about OPEC plus and them increasing quotas, etc., well, the marginal producers in OPEC Plus are really only Saudi, Iraq, Iran, UAE, possibly. I mean, when you look at like the OPEC Plus outside the big four, well, A, they don't have much capacity, and B, they cheat. So Russia, Kazakhstan, Iraq, and the UAE, they never cut. So when you're talking about increasing their quotas, well, they're not going to obey that either.
Mm.
They just will produce whatever they like. These are EU natural gas futures, well down on a year ago, and that's great news. And as an aside, so natural gas, um, we know that there's a lot of LNG capacity coming online. And also, our work has restarted on the Trans-Sahara gas pipeline, which promises to provide Europe with cheap Nigerian gas. So, talk about the energy transition. The energy transition is going to be replacing coal with natural gas. So when I say it's resumed, it will soon resume, I'm told. UK natural gas futures, very good, still down towards their lows. US natural gas futures going nowhere, right down at the bottom. And okay, so during the week, I listened to a Doomberg piece, and frankly, I thought he'd lost his mind. So he was saying that AI data center power demand was going to be so enormous that it was going to mean that the price of natural gas in the US was going to rise to the extent that natural gas became traded at a premium to oil, so that shale oil drillers would make more money from gas than they would from oil, leading to them drilling more wells for the gas, with oil as the byproduct, leading to essentially the oil price going down.
So I think I don't listen to Doomberg. I deliberately don't listen to him because I'm not sure that I entirely trust his agenda.
Right. Well, I just think he's.
And I always say, who would listen to an anonymous chicken? And that's my
Well,
view of Bloomberg. I don't listen to him because I don't trust why he says what he says.
well, yeah, yeah. Listening to green chickens, obviously, in general, not a good idea. Which stop taking the drugs. But I've just all you need to know is this.
Stop tucking at me.
So this is EOG, and the red bar is their gas production. The green bar is oil, yellow, natural gas liquids. What it's saying is their production is getting gassier. Yeah. There's just vast amounts of gas coming out of the US. And it's a byproduct that
So
they just want to get rid of.
I was
Gone.
do you still listen to macro voices?
I haven't actually in years, no.
So I'm quite partial about which ones I listen to but yesterday I listened to he was interviewing Jeff Curry, the ex-head of commodities trading
Oh,
at Goldman
yes.
Sachs. And I like Jeff Curry. He's a really
Yeah.
interesting guy to listen to. And it was a really interesting discussion they had and his views. And basically, he was saying, he said, I have never seen why people say there's an oil glut. I don't see any evidence for it. I don't know where this story has come from. And this story has come because it suits the US to talk the oil price down because it keeps inflation down. That's where this has come from. And
Right.
that's why I'm suspicious about our friend the green chicken.
Ah, got you. Okay. Well, I'll go and listen to that. Thank you, Richard. This is Cole looking strong. How's the energy transition going? Question mark.
Well, the issue with coal, there's two issues with coal. One is, that how much steel can you make with green hydrogen? I think you can make enough for about one girder a year, can't you?
Yeah.
And so coal is absolutely required for blast furnaces, metallurgical coal. And if the world economies are growing, which they are, and they're building and making cars, which they are, you need coal
Mm,
for blast furnaces. It's like,
yeah. If anyone is making girders out of green hydrogen, I bet it's us.
and yes, and it's called the edge girder.
Yeah, the edge girder. Yes.
And of course, you need coal to make polysilicon for solar
Yes.
panels.
Yeah, absolutely you do. But anyway, I thought this was really interesting. This is the cost of utility scale batteries. Blue line, left hand axis, and they have more than halved over the last 5 years. And therefore, their usage is going up. That's great news. So, are you going to get loads of batteries all around the grid to replace coal? Now, that's actually what's happened in the UK. But given we have the most expensive electricity in the world, I do question how many other countries are going to be adopting our system, successful though it is. Um, and this is uranium. Still looks like the bull market's intact to me,
Yeah,
actually.
yeah.
And on to industrial metals, Richard. Now, I should say this week, all the charts are 5 year charts, just for
Right. Okay, that's going to be interesting. Thank you, Keith. Okay, so is it a year to date? Still a year to date, though.
yeah,
Yeah. So aluminium up 2.6%, cobalt unchanged in the last 2 weeks, copper up 3%, 6% year to date. Iron ore down 1.4% and down 7% year to date. Lithium carbonate, goodness me, up 45% year to date,
yeah. God,
20% last 2 weeks. Neodymium 53%
yeah,
year to date, 8%, and nickel 7% year to date, 4% last couple of weeks. Tin 32% and
yeah.
8%.
Tin, the big winner.
So
Jeez.
there's a clear trend there, isn't there, amongst basically all of the industrial metals, apart from iron ore,
Yeah,
which is significant increases in their prices.
yeah,
So there's aluminium, cobalt, copper.
yeah. That looks like the trend's back on.
Yeah.
Ah, Richard. Okay, so I have been working on my copper presentation, which I found very interesting, but is now
Right.
going to be far too big to include in the weekly, so we'll spin
Right.
out. But quick, so I've been looking at a few mines around the world.
Yeah.
Okay. And obviously, the spike in copper was started by mine disruption, including at the huge Grasberg mine in Indonesia.
Right.
Okay, so what is the volume of the tailings that the Grasberg mine produces? Okay,
Blimey.
so it's the largest mine in the world. Does it produce 700,000 tons of tailings per hour, per day, per week, per month, per year? 700,000 tons. That's a lot. Gone.
So what's it mining at? 2%? How many? How many
Less than that, actually.
is it?
Less than that, yeah.
How much? What's its annual production?
Can't remember now. A lot. A lot. 4%, between 3 and 4% of the world's production.
Let's say it's 100 million tons a year. That would be 700,000 tons a day.
Spot on. Well done. 700,000 tons a day
That's
then.
that's a lot, isn't it?
I was
Oh,
flabbergasted.
processing that volume of material is extraordinary.
Yeah. The environmental destruction associated with this does really not bear thinking about. Okay.
No.
That's that's it. Okay. There's a huge hole in the earth. And actually it's 4,000 meters up in the mountains of Indonesia, West Papua. And when you look at like photos from space, you can see glaciers next door to it. It's right up there.
Yeah,
Uh, the
extraordinary, isn't it?
So anyway, the copper special will be out in due course.
Iron ore price.
Yeah, there's a lot of iron ore coming on. I'm not bullish about iron, frankly.
No. Lithium.
Now, I thought doing a 5-year chart was quite revealing because, we've seen a huge, like, massive increase over the last 6 months. But
Yeah.
when you look at the price spike we had back in 22,
Yeah.
yeah,
I wonder where it's going to get to this time.
unknowable, mate.
I agree. Neodymium, which is moving up fast.
Yeah.
Nickel. Tin.
Yeah. The thing is, tin, how high can tin go? Because tin is very rare and it's essential to electronics. And everywhere we're seeing huge capex in electronics.
Yeah. And the only thing can be substituted with is silver.
Yeah.
I made that up, but it's probably true. If you're not using lead.
Well, silver and lead, yeah.
And there's zinc. So just before we move on to that chart of gold versus other commodities that you showed, where there appears to have been a recent decoupling. At the moment, it looks like the other commodities are moving up as opposed to gold moving down, doesn't it?
Yeah.
Precious metals. So the weekly change for gold is 4%, silver 16, platinum 11, rhodium 11. So the interesting thing is that despite the huge volatility of silver, it's up significantly year to date. So there's gold up 20% year to date.
So this is volumes on call options for December 2026 gold. And there is loads. Well, everyone, if the people are betting, they're betting big. They're saying like gold at 20,000.
Yeah.
Wow.
Apparently, if these options are, if the price, I read somewhere like the profit in these options, if the price goes to something around about 20 over 20,000, which depends how much it goes over by, it's up to about 3 billion the profit. Wow. And the cost of the options, I think, is 300 million. So, I mean, yeah, but who's put that amount of money in? Who's put 300 million pounds into these options?
No idea.
Why?
Well, that's a question.
It's not us, is it, Keith? So, Shanghai Futures Exchange continues. So did you see that the Reserve Bank of India, the RBI, has mandated that the pricing of silver in ETFs and similar Indian funds will be taken from local Indian exchanges and no longer taken from the LBMA.
Oh, very interesting.
Because they don't trust the LBMA price anymore.
Oh, right.
Because there's so much price fixing going on. I think the LBMA has cooked its goose. I think that it is going to be yet another venerable British institution that destroys itself.
Can you just explain what's been going on with the
bullion
metals exchange
association?
Okay.
Yeah. So, and basically, there's been a lot of silver and gold price manipulation. So, and the two main parties in that have been the LBMA and the COMEX.
Okay.
And but what's happening? You showed the volume of paper claims on silver, for example, would be 200 times the amount of physical silver available. And whilst there has been a surplus of silver and gold, physical silver and physical gold, that sort of manipulation of the price via the paper markets has been eminently achievable and has been happening for many years. And there's a question: has it actually been happening because a low gold and silver price suits the purposes of the operators of the world's reserve currencies, because a high gold price tends to undermine the validity of the reserve currency? So So that process works until you find that there is insufficient physical gold or silver to cover the paper contracts. And then you get a big short squeeze. So one of the ways around the short squeeze is to start pumping and dumping the price on the exchanges, which is what we saw the other week with silver, where it was pumped up to $120 an ounce and then dumped down to $54 an ounce in the space of a few days. And that wasn't the price of physical silver. That was the exchange manipulating the prices to flush out holders of contracts, paper contracts. Partly to put the big bullion banks square, because they hold large short positions. And there's that guy who used, the Chinese guy who used 15 or 20 different entities to short massive quantities of silver on the Shanghai, I think, exchange, who have been basically reprimanded by the Chinese, told to cancel his positions, because the Chinese don't want the price of silver to be fluctuating like this, because they encourage their citizens to own silver. So I suspect that guy is going to end up in a Chinese prison in due course. So he won't be able to spend his ill-gotten gains. But it's plain to everybody, really, that there's a massive price manipulation going on in these markets. And the Reserve Bank of India has said, so the Reserve Bank of India has stated that silver is now a reserve currency in
right.
And they don't want the price of silver to fluctuate like that. If they're going to be using it as part of their currency system, clearly they want it to be stable. And if you've got these shenanigans going on in the LBMA and the COMEX, it's highly unstable. So effectively what they've said is we will no longer price our silver off these markets. We will price them off our own internal market. And what that means is that they're still big, but the validity of the COMEX and the LBMA is called into question. And whether they survive it, or particularly I think whether the LBMA actually survives it, because its reputation is trashed by the sort of the dealings, the massive manipulation of prices. Whether it survives that reputational damage in the long term, I don't know. I think it's
so. Richard, the Indian markets, are they financialized, or are they pure physical?
They're very much physical, Keith.
Right. Okay.
They're not nearly as financialized as the Western markets, as it were.
Right. Okay. Interesting.
I'm happy with the top left, Keith.
Yeah. But you've got the bottom right. Anyway.
So there's the price of silver.
Yeah.
Platinum, I mean, it all had this big spike a few weeks ago, didn't it? And then a drop down. Rhodium. Palladium.
Okay, thank you, Richard. And on to rates. Hurrah! UK yield curve has come down, still very high, and still a very steep yield curve. I mean, I remain astonished by the fact that 2-year is the 3.5%, more on that in a bit. This is the US, and despite having a fiscal deficit that is out of control, and which Donald Trump will now be liable for 175 billion of rebates, yields across the curve lower than in the UK. So this is UK 2-year, 3.5, 3.6%. It seems still astonishingly high. The market expecting the Bank of England will not be able to cut rates very much. But reminder, UK has inflation that is coming down, GDP growth that is 1.0%, and ongoing fiscal consolidation. I think it's going to have to cut rates a long way from here. So far, I've been dead wrong. But looking over the past 5 years, is are UK rates starting to come down? Question mark. Fingers crossed. Still astonishingly high. More on that in a bit. US 10-year, you know, is that flat or coming down? Question mark. The moron premium, thankfully, seems to be fading. Although you'll notice that, in 2022, the markets were charging a premium to lending to the US relative to the UK. Now it's the opposite way round. Of course, the UK was then doing vast amounts of QE. German 10-year, French bond yields all come down a bit over the last couple of weeks. Italian, Greek, stable. Japanese actually come down over the past couple of weeks, although frankly, looks like a blip with the trend still remaining upwards. I had my call with my US fund
So,
management friend yesterday, and he was actually talking about buying Japanese 30-year. So,
really?
contrarian view.
So I was
Yeah.
going to ask you, Keith, I was going to ask you if the carry trade is Japanese carry trade is over.
At these levels, if it
Yeah.
keeps rising, it's going to be, yeah. But um, so we'll talk about this a bit more in a bit, actually, Richard. Because when we talk about inflation, I've got a really interesting slide showing, talking about the effect of demographics. Okay, and on to investment themes. Well, so we're going to get through this quite quickly because there's really not much change. We're still looking at AI development, being, obviously very huge revenues for the AI hyperscalers, but how sustainable is that long term? And frankly, the market seems to be growing more skeptical, as you've seen from, in fact, Nvidia massively beat earnings, but the share price didn't move. AI disruption, however, is a real current theme in the markets with software companies coming off sharply. The monetary debasement trade is back on. So gold and silver have had a good couple of weeks. Commodity scarcity. Again, is it scarcity or is it just the halo trade, as Richard has said? Energy abundance, well, that seems to be fading a bit. We may be taking that out in coming weeks. Peace in Ukraine, question mark. Geopolitical uncertainty, well, that's very much a theme. Will Trump start bombing Iran? Odds on, I'd say. Financial deregulation and fads. If anyone's got some fads, please write in. I'm looking for a fad. And on to this week's economic data. So, quick summary: UK stagnation turning. So, UK stagflation turning to stagnation. Inflation has hit a near-term peak and is forecast to come down towards target by April, thanks in part to Rachel Reed's manipulation of the UK energy prices.
Can I just chip in there, Keith?
Go
I
on.
am still not convinced that UK is out of the inflation woods.
Okay. Right.
I could
We've
say I'm
got
hedging my bets here.
we've got the trueflation data, which seem to agree with you coming up, Richard.
Right. I just
EU's
think with the commodity price increases. Yeah,
yeah.
carry on.
Yeah, true. EU stagnation, basically we're back to pre-pandemic. So low inflation, low growth, 1.3%, US nowcasts suggest the US economy is doing just fine, but the labor market is definitely softening and the cyclical components of the US economy have slowed. But as they've slowed, they've been replaced by AI capex spending, of which more later. China, doing fine, but it's very difficult to know, essentially. On to the UK, Richard.
Thank you, Keith. So January CPI down 0.5% and year on year 3%.
But down a
Up
lot.
3%.
Yeah,
Yeah.
down a lot from December.
Yes. Core CPI month on month in January down 0.6% and year on year up 3.1%.
So still too high. So how long's it been above target? Is that like best
But,
getting on for 4 years now?
yeah, and then there was
Five?
that big time, wasn't there, where was it whoever was the governor of the Bank of England, was it Mervyn King, kept having to write letters to Gordon Brown. It was a long time ago, wasn't it? I'm sorry, I'm living in the past now, Keith. Just cut that bit out. RPI month on month, January down 0.5%, but year on year up 4.2%.
Yeah.
And airfares, falling airfares, a big contributor to disinflation in January. If you're living on the breadline, the fact that your airfare fell is probably not terribly relevant.
Mm.
Food and drink price inflation, that is relevant also.
Yeah. That is great news.
And CPI, goods service core inflation rates, you can see that the goods inflation actually is now currently the lowest, and the services is currently the highest.
Yeah. And services is still too high. And it's coming down at an absolutely glacial pace.
Yes, yeah, it is. And CPI compared with various G7 and EU annual inflation rates, I'd say it's one of the things that we seem to be good at, Keith.
Inflation. Yeah.
Yeah, it's good to see that we're leading the pack somewhere.
Not yet world class, Richard, but give us time.
Give us time. Rachel is working on it. So a dropout model suggests that UK inflation will return to target in April. I would just say if only the world were that simple.
Yeah, I know.
And UK earnings growth, including bonuses, 4.2%. So dropped a bit.
Fading back towards, normality.
Yeah, and year on year, excluding bonuses, 4.2%. So if you're working in the public sector, you are doing significantly better in terms of earnings growth than if you work in the private sector.
I mean, frankly, I found these numbers pretty shocking. Public sector, 7.0%.
The other issue we've got is, there doesn't seem to be any capacity, ability, wish to manage public sector productivity.
Well, depends. A cynic would say there's quite a lot of desire to manage the public sector productivity because you just change the numbers, change the assumptions,
I'm talking real productivity.
Yeah, well, exactly. I mean, the number of civil servants has shot up since the pandemic. Does anyone think that public services have got better?
No.
No.
Average weekly earnings growth rates for different sectors there. You can see that the white collar growth rate is at finance and business services is only 2%, whereas public sector, as Keith pointed out, is 7%.
Yeah.
And 3-monthly employment change in December was up 52,000, much better than expected. And the UK employment rate, 5.2%. The problem with the UK unemployment rate, indeed, is the rate of youth unemployment.
Precisely.
Which is shockingly bad.
Yeah. But also, according to the household survey, it was like employment going up by 52,000. So how come the unemployment rate is rising?
Well, data's all over the place, isn't it?
Yeah.
RC payroll suggests that January employment dropped by 11,000.
You see, this seems much more plausible to me. This is compatible with the rising unemployment rate.
Yeah, I would agree with that, Keith. UK claimant count in January is 28,600 increase, which is also compatible with the rising unemployment rate. Productivity growth, that's not growth, Keith, actually. That's shrinkage, down 0.6% in quarter four. I mean, it's like, what's going on?
This is an absolutely shocking um, chart. It shows essentially productivity has not grown in 5 years. I wonder how much of this is the death of energy intensive industries in the UK.
Yeah, you could be
Yeah.
right, Keith. It's
And, and all those people going on to become hairdressers or something, you know.
and if we're looking for an AI impetus, you would expect to see that productivity figure start to increase quite significantly over the next few quarters.
Yes. Yeah.
It'll be
Well,
interesting to see.
that will be very interesting.
So, our retail sales month on month up 1.8% in January, and year on year up 4.5%.
Those figures are much better than expected. A bit of UK um, reassuring itself, making itself feel better with a bit of retail therapy.
Binge buying.
Yeah, question mark.
Um, Manufacturing PMI is basically unchanged from last month.
But positive.
Positive, yeah. Services PMI likewise.
And that's a decent number,
Yeah.
actually.
And there's the composite, which equally is not really very much change.
Yeah, that's all good.
PSBR, some nice juicy tax receipts there.
Yeah, exactly. Hurrah. Well, at least, all those tax rises have actually resulted in some tax revenue as opposed to just, everyone fleeing the country and tax revenues actually going down.
I know. I think we'll have to wait to see what happens in the next few months, won't we, to see how it balances out. Indeed,
Yeah.
job posting actually up very slightly. So that the UK does rather look it's sort of leveled out. It's not actually leveled out, but it's certainly the
Yeah.
rate of decline is very slow.
Stagnating.
Yeah. UK wage growth basically still falling.
Yeah. Yeah, I don't know what's going on with this chart because previously we reported December wage growth at 4.3%. Now it's 4.1, but I don't
I mean,
know.
basically, we need productivity growth of 2%, don't we? And then we
We
would
do.
have our target inflation of 2%.
Yeah, exactly. Because actually, with a productivity growth of zero point 0.6, let's say it's annualized at minus 0.6%, then real wages are rising at 4.7%.
Yeah, which, as you say, stagflation. UK trueflation, oh gosh, heading back up 2.7%.
Mm. Now, obviously, with um, trueflation not as reliable in the UK as it was in the US. There's no way on earth that it was
Yeah.
less than 1% last April. But we think the trend is sort of right, so that's not great.
So UK gilt sales forecast to come down slightly next year.
Yeah,
First time in 4 years.
and still just in an absolute terms, really high.
And, but then, there's all these things like the, I don't know, we need to up our defence spending by a massive amount, don't we?
I know. I did like Rachel. The purported wheeze by the Labour government was to, split it out as a separate defence fund that wouldn't be included in government borrowing or something.
They could do that with everything, couldn't they?
Yeah, exactly.
But we won't include the NHS. 6 month annualized inflation is at 2.2%.
Yeah, so that's good news.
So there's a summary. Unfortunately, the bottom line is stagflation subsiding into stagnation because our productivity growth is so falling.
Yeah. Okay, now I've been thinking about the UK budget deficit, and my thoughts were prompted actually by my conversation with my US fund manager friend yesterday. So currently the UK fiscal deficit is 5.2%. Yeah, and it's forecast to fall to 1.9% by 2029, 2030, i.e. the end of this parliament. Yeah. So of that 5.2% deficit, 3.6% is interest expense. So the primary deficit must be 1.6%. Now, My fund manager friend's comment was about the interest expense, and we were talking about fiscal multipliers. And there's a difference between the interest expense and general expenditure. So the interest expense all goes to institutions and, well, mainly institutions and some to savers. And we suspect the fiscal multiplier of interest expense is very low. So, and this is the current deficit. And so that's current revenues minus current receipts. So it doesn't include investment, and that's currently 2.6%. Public sector debt is around 93% and is forecast to be kind of stable over the course of the rest of the parliament. So the point is that UK GDP growth is at 1% currently, when the fiscal deficit is 5.2%. Over the next 4 years, the Labour government plan is to cut the deficit to 1.9%, which implies a fiscal consolidation of 3.3% over the next 4 years, or around 0.8% per annum. Now, assuming a fiscal multiplier of 1, that implies UK GDP growth will fall to 1% minus 0.8% equals 0.2% per annum over the next 4 years, unless Rachel Reeves' novel high tax, high bureaucracy growth plan starts to work. And we are skeptical. So that implies I just can't see this fiscal consolidation happening, actually.
Well, this is the debt trap, isn't it? That people don't really
Yeah.
understand, which is if governments borrow, if they borrow too much and it has to be paid back, it comes straight off. You know, when you borrow and spend it, it goes on to GDP. When you pay it back, it comes off GDP effectively.
Yeah.
And so it's a trap, and it's and also yeah, it's a trap. You can't pay unless your economy is really very vibrant. You can't
Yes.
governments
You
can't
can't pay
pay
back.
debt back.
Yeah. I agree. And so I think there's very little chance of the UK government being able to execute this plan for fiscal consolidation
The
because
only way they, sorry, Keith.
they will cut our non-existent growth to zero,
Yeah.
basically.
The only way it could be done is to have a significant increase in productivity, and then the country is creating
Yes.
growth, which is then available to pay down debt,
Yeah.
and
I
that's what
totally
needs to
agree.
happen. And
Yeah.
but they don't understand this. It's too complicated. So they haven't got their heads around it.
Well,
I think very few people understand it.
the trouble is, as Richard says, we are now in a trap. So the bond market is not going to fund higher deficits without demanding higher yields. So it's likely the UK is going to be stuck in a low growth, I think, low inflation, steepening yield curve economic malaise for years. So the Bank of England, as growth slows, can cut short term rates, but the bond market is concerned about the UK fiscal situation. And as growth slows, so is going to be more concerned about the long term path of the UK fiscal deficit and our debt levels. So that implies long bond yields are not going to come down as much as the government would like, or I would like, frankly, or enough to stimulate the economy by reducing long term interest rates to allow more investment.
And that's why I've always been skeptical of the thesis that interest rates can fall because
Yeah.
we are stuck in this. We're stuck in this trap.
Yeah.
I mean,
So,
sorry, Keith.
well, the danger is I fully expect that they won't be able to do this fiscal consolidation because it just is going to be too painful. The effect on the economy was slow. So the danger is that Labour then comes under intense pressure to abandon its fiscal rules, which would be bad for the bond market. So you appreciate your input on this, Richard. So my thoughts were bad for sterling. Fundamentally, the Bank of England can cut interest rates, but In order to stimulate, you can stimulate the economy three ways. You can increase fiscal spending. Well, we can't. You can cut interest rates. Bank of England can do that. Or the exchange rate will fall, which is slightly out of our hands. But as growth slows and interest rates fall, expect sterling to fall. So falling sterling means buy physical assets such as gold, silver, copper, oil, or foreign assets, anything denominated in a harder currency. Swiss government bonds, maybe not US, but anything non-British, basically. It's also good for UK disinflation, but long bond yields probably not fall as much as shorter yields. But even with a steepening yield curve, the cut in short-term rates should ensure that long-term rates come down. As disinflation occurs, that means the premium the market is charging to lend long rises. So you'd expect long-term rates to come down even if they don't come down anywhere near as much as to levels they were pre-pandemic. In absolute terms, they'll come down, but you'd still expect a steeper yield curve. Finally, bad for UK equities that depend on domestic demand because growth's going to slow through fiscal consolidation. So UK consumer-focused stocks, retailers, things like that. Your thoughts, Richard?
I generally agree with what you said, Keith. I think nothing in terms of foreign assets. I think if you look at what this is predicated on my worldview, which is that hard commodities are underpriced and that the price of those commodities over the next few years is going to go up substantially. That's my worldview. If I'm correct, then other foreign assets would be Canadian and Australian because they are economies that will benefit significantly from increasing commodity prices if you own that. And so therefore the pound will depreciate against their currencies. I think that's a possibility. I'm not optimistic about inflation generally. I think that energy is underpriced.
Yes.
I think it's going to have to undergo a significant repricing, and that is bad for inflation.
Yeah, I agree.
Yeah. So I don't think that inflation is actually particularly within our control in that sense, because we are very vulnerable to changes in pricing of energy worldwide. And with our falling productivity and very high internal energy costs, because of the way the market works, it doesn't work, I'm not optimistic about inflation. So I think it's bad for gilts, generally bad for as you say, bad for UK equities, depend on domestic demand, good for UK equities that operate businesses overseas.
Actually, that's a very good point. Yes, buy UK equities with strong overseas earnings.
Yeah.
Yes, I should have put that in. Yeah.
So yeah.
Okay. Quiz of the week.
Have we finished the optimistic section now? To my family trouble.
Okay. Quiz of the week number 2, Richard.
Oh wow, yeah.
Okay. Actually, this is the optimistic section.
Okay.
No, right. So the Labour government has set a target for London to build 88,000 new homes every year over the next decade. How many new homes were actually started in 2025?
So I think it's something ridiculous like 5,000, isn't it?
Yeah, you're right. Damn.
5,800.
Rachel Reeves, growth plan. Here you go.
What they don't understand, these politicians, is there's a difference between saying, I would like this to happen, and actually making something happen.
Yeah.
And they're very good at saying, I want this, and they're very bad at initiating action which enables it to happen. Yeah. We want the UK economy to be vibrant. Well, cut energy costs. So we can't do that.
Yeah, exactly. I know, that's the thing. The growth plan, it's actually the Labour government doesn't want. If you wanted growth, you would reduce the minimum wage to get more people into work, cut bureaucracy, cut energy prices, etc. Doing none of that.
It's
So
just lip service, isn't it? Go with the action, not the words. What's the
yeah,
action?
yeah. Well, there you go. That is the action. So basically, when you look at what's happened, why London house buildings collapse, it is in large part more bureaucracy, increased standards for safety and insulation, etc., etc. And I was thinking when we talk, a lot of this is post Grenfell. So, the London Tower block that burnt down, and it was in largely due to contractors putting on these unsafe panels, external panels. And again, this is something you don't need regulation for. What you need to do is to have it very clear legally who is liable. And this is Ronald Coase's argument for why you don't need government. You can, if the legal system can handle it, if you have very clear demarcation of responsibility and a strong legal system. But as it is, what we do then is put in loads of paperwork, which gums up the whole system, and people are not held responsible for their bad actions.
Yeah.
Um, so there you go. House building costs going through the roof, largely thanks to more bureaucracy. And on to EU. So we're going to go through this quite quickly. So EU GDP growth, Q4, 0.3%, 1.3% annualized, slow but steady. Employment growth in the EU has been really very good, actually. So 0.7% year on year. And we talked about previously, unemployment is at a new low. Industrial production, surprisingly, 1.2% year on year. That's okay. Manufacturing PMI actually improving. Services weak but steady and actually up a bit in February. Composite therefore improving. So EU economy weak but stable. Loans to companies were weaker than expected but okay. Loans to households also okay. Money supply growing at 3.3% per annum. Current account still in surplus, surplus growing. EU is paying its way in the world, but indeed job postings in Germany continue to fall. Wage growth is actually compatible with the 2% target. France, not great. Wage growth, very weak. EU summary, stagnation, basically. I can't see any catalyst for the EU to start growing strongly, really. It's just stable at weak. And on to the US, Richard.
Thank you, Keith. So US GDP growth quarter on quarter, 1.4%, quite low relative to expectations, and basically due to the shutdown, significant shutdown, and lack of government expenditure. GDP sales quarter on quarter, 1.2% in quarter four.
Yeah, not great.
Again, down, yeah. CPI 0.2% in January and 2.4% year on year.
Yeah, below expectation. That's good.
Yeah, core CPI 0.3% in January and year on year 2.5%. Median consumer price index, all of the different indices are falling. And they're quite closely aligned, aren't they? 3-month annualized supercore is at 1.13.
Yeah.
Owner equivalent rent still overstating inflation. And if you substitute real-time measures, you get a significantly smaller number, well below 2%.
Yeah. So the weak consumer actually in the US does appear to be feeding through to, weaker demand, he says.
US health insurance price index has fallen 20% over the last 5 years.
Mm. Yeah. I don't know how on earth they've got away with this. I don't know what on earth's going on.
Mm.
Yeah, that is clearly, manipulation of some kind.
Isn't it? Yeah, I mean, it's like, it doesn't make much sense at all. Perhaps they change how they calculate it.
Hedonic adjustments, Richard.
Yeah, that's right, actually. Yeah. Service inflation in the US now back to target. And, comment about tariffs. Tariffs, we will.
Yes. Yeah, we'll see.
Electricity demand from AI data centers driving up electricity prices for everybody.
Yeah.
There's going to be some kickback on this, some pushback at some point fairly soon, with the tech bros making billions and it being the power consumption being subsidized by the everyday individual. PCE prices month on month, 0.4% December, year on year, 2.9%.
Yeah, and heading in the wrong direction, actually.
Yeah,
it's
slightly
quite a different chart from the CPI.
Yeah. And core PCE, 0.4% and 3%, respectively. Personal income month on month, up 0.3% in December.
Solid.
Yeah. And personal spending up 0.4%.
Yeah, solid.
And US consumers drawing down savings to support consumption, and can't go on forever. That's a fairly significant trend there, isn't there?
Yeah, that is a low number, actually.
US durable goods orders month on month are down 1.4% in December, which is actually better than expected. Of course, December is not a good month. But industrial production, 0.7% in January, 2.3% year on year, which is good.
That's all right. Say the benefits of having low energy prices, Richard.
Yeah. Manufacturing PMI 51.2 February. Services 52.3. I mean, all just looking fairly steady, aren't they? Composite 52.3. Actually, a bit of a fall.
Yeah.
Last 6 months.
Some weakening. Yeah, over the last 6 months.
Yeah. Michigan consumer sentiment 56.
Weak.
And the consumer confidence index 91.2, which is actually oddly enough, it's on a downtrend. Chicago National Activity Index up a little bit in January.
Yeah, so that's interesting. That's saying that the US economy is actually recovering a bit, is working above trend in January for the first time, in a while.
Yeah. US building permits looking very healthy.
Yeah, surprising.
US housing starts looking healthy. Case-Shiller month on month, December down 0.1%, up 1.4% for the year. Initial jobless claims 212,000, but looking pretty much steady.
Yeah, no sign of a rise in unemployment.
No. Continuing jobless claims actually quite low.
Yeah, absolutely.
Indeed, jobs posting, it does look like it's plateaued, doesn't it?
It does. That looks like it's bottomed to me.
Indeed, wage growth still falling, 2% in January.
Yeah. That suggests disinflation.
And link up, jobs postings are falling again. I don't really rate this data.
Yeah. Well, the thing, the monthly ones actually had a bit of a bounce, actually.
Yeah. Pay premium for switching jobs is at a new low. Almost nothing, really. Dallas Fed weekly GDP 2.6.
Yeah.
Atlanta Fed 3.1. New York Fed 2.4. St. Louis 3.
Yeah, so all fine, basically.
Yeah. And truflation 1.3%.
Yeah, but rising again.
Yeah. And a contradiction of the US labour market, we can see jobs plentiful versus hard to get is rising, and initial jobless claims are falling.
Yeah. So consumers are feeling bad about the jobs market, but there's not much sign that it's actually deteriorating.
Yeah. Auto loan delinquencies are still rising.
Yeah, and record levels,
Yeah.
actually.
Yeah.
So,
Quite a
you know,
steep increment there.
so the poor in America are doing, financially stressed. Financial stress is rising.
Mm. US national debt is on this parabolic chart
Yeah.
path. The higher interest rates that are persisting in the US mean that house prices basically are too high, so transaction volumes have fallen. Although that's
Yeah.
not borne out by the starts and
Yes,
permits, is
I
it?
know. Absolutely. Absolutely. So the market for existing homes is stagnant, but house builders continue to
Mm.
build.
Freight shipments continue to fall.
Yeah,
But
that's not great.
no, but the US economy is doing very nicely in total. So various cyclical components have weakened, but obviously we know that the AI investment is massive, and that's one of the things that's holding the US economy up.
Yeah, I thought this was a really interesting chart, actually. So, you know, durable goods consumption, residential investment, business equipment investment, or, those are cyclical components of GDP slowing,
Yeah,
but, been compensated for by a rise in AI investment.
yeah.
Here you go.
And that's a graph showing AI investment. So that's our summary. So the US economy has experienced a little bit of a downturn cyclically. It's been very offset to date by AI infrastructure investment.
So thank you, Richard. On to one chart. So on the y-axis, it's labor costs as a percentage of revenues. And on the right, sorry, the x-axis is exposure to automation by AI. So when investing, you want to find a sector where you're not really exposed to being substituted by AI, but where you can cut your labor costs. So I think what's most important is not being exposed to automation by AI. And so you don't want to be in software, etc. You want to be down here somewhere, or actually theoretically up here, where you can substitute labor for AI, but survive the AI revolution. Where you don't want to be is up here, software services, etc. I think here you're going to see a lot of your revenue disappear. I thought a big winner could be banks because they've got a huge moat. What you need is a moat that's going to protect you from AI. So, big brand name or regulation. Banks very highly regulated. Your thoughts, Richard?
I I struggle with this sort of thing. I think it's sort of laying a degree of certainty um, on the impact of AI that simply doesn't exist.
I
Um,
sense you've got a great deal of skepticism about AI, Richard.
I mean, I think it has its uses, Keith. Don't get me wrong. I think it will find its. And obviously, as it evolves, um, it'll become more focused, I guess, and more useful. But I just think everybody's running around panicking a bit about this, and I don't really don't see it.
Mm,
Um, and I think it's like if you just take uh, commercial and professional services. Well, part of it is exposed to automation, but part of it isn't.
yeah,
Um, but this is basically, it's quite nuanced. Software services, we've discussed this. There's a
yeah,
bit of it that's exposed to automation by AI, but at the moment, a lot of it isn't. And this is sort of saying, this was really black and white. We know what's going to happen. And I just think
yeah.
it's not true.
Well, I think a lot of software companies just going to find their pricing power just totally disappears.
The other
They
thing
might
is,
not. Go on.
Sorry. It says labour costs as a percentage of revenue, right? But one of the things we discussed is that AI is actually vastly subsidised at the moment.
Yes.
When you actually pay the market rate for it, this assumes that AI is free. It's not free. It won't be free. And when you pay the market rate for it, people are going to have to make a decision. How much better is AI than Joe or Sarah sitting over there?
Yeah.
And none of these people have taken that into consideration. None of these analyses take that into consideration.
That's very true. That's very true. Good point.
I think it's just premature.
Okay.
Sorry, I'm just not. I'm not towing the party. I'm not towing the AI line.
Okay. Well, while we talk about AI, let's do the AI capex boom, which is enormous. So hyperscalers are forecast to spend 600 billion in 2026. Now, let's put that in perspective. I think the UK GDP is around 3 trillion. So it's like 20% of UK GDP. And it just keeps on rising, basically. So when you look at, estimates of what the hyperscalers are going to spend in 2026 and 2027, they just keep on increasing. I'm willing to go bankrupt rather than lose this race, says Google co-founder Larry Page, spending vastly more on capex but as Richard points out, where are the revenues? Everyone's making huge assumptions about revenues. So only around 50% of capex spending is now funded by cash flow over the next 3 years. The hyperscaler is going to take on 1.5 trillion, 1.4 trillion of debt.
And OpenAI said it's going to start advertising because it can't raise revenue any other way. And as soon as it starts advertising, its raison d'etre has disappeared because it just becomes a souped-up marketing engine, which Google already is. But
as of December 2025, tech sector debt was already 1.35 trillion, and they're going to add another 1.5 trillion. But their leverage ratio has actually been falling. This is the ratio of assets to liabilities. I mean, if you count the data centers you built as an asset, then
Oh, but they're low. I mean, high. They're a high obsolescence asset.
Yes, well, exactly. Yeah. Well, how much revenue is he making from these things? But the bond market is increasingly skeptical. I mean, that's the CDS on Oracle bonds. Significant.
Like the silver chart, Keith.
Yes, that's right. The hyperscalers have, their balance sheets have shown lots of deterioration over the last 5 years as they're going from an asset light to an asset intensive model. I thought Ali Boyd sent us this. This is interesting. So Apple have stayed out of the whole AI arms race. Isn't that interesting? Makes me want to be, more positive on Apple, frankly. But this is the chart, Richard.
Yeah.
So this is the chart. This is on the left. We have the brown line is a .com share price index, and the grey line is .com earnings. Now you'll notice when they were all investing huge amounts in IT infrastructure during the .com bubble, their earnings were great. It was a circular economy. Here we go. That's the analogy. Yeah. As soon as they stop spending capex, those earnings are going to come down. Nvidia being the obvious example. So how will all this capex affect the US economy? This is an analysis by Bridgewater. So they're saying it's going to raise US GDP by 140 basis points in 2026, 150 basis points in 2027. But as Richard says, that all depends on investors being willing to keep on stumping up and provide them with the debt to allow them to do this. At some stage, unless the revenues come through, investors are going to start demanding higher premiums, etc., and the circular game comes to an end. But they're also saying that AI capex spending will not support labor markets. So spending is limited to a few specific sectors, and tech companies may cut jobs to support their capex expenditure. And I think we are seeing that. So, and they're also saying that AI has not yet created significant productivity improvements. Certainly not true in the UK. So, on the basis of AI capex expenditure, Bridgewater are forecasting that the US GDP will beat forecasts. So, their Bridgewater's forecast is the blue dot versus consensus, the green dot. So they're saying bullish US growth, but they're also skeptical. They're saying the labour market will be weak. That's what's happening right now. So global data center capacity, the forecast is going to go through the roof. Who's going to pay for this? Like pay the
The
red.
other thing is, Keith,
Oh.
there isn't the energy for it. So I think planned US data center capacity is about 10 gigawatts. So if your average nuclear power station produces a gigawatt, the energy just doesn't. It doesn't. The energy isn't there.
Well, you can see they're bidding up for energy in the markets.
But even so, ultimately, the price will go up. But fundamentally, it's not there. So,
well, you just need some poorer people to exit the grid, Richard. You heard it here first.
It's a pyramid, but it's balancing on its tip.
Yeah. Oh, so that's the improvement in large language models, and they are improving, no question. So 1 gigawatt. I mean, that's such a lot of power.
It's a nuclear power station.
Yeah, 42 billion of capex spending equals 30 billion of US GDP. That is a lot. So, on Richard's points, possible choke points which would limit this spending, this amount of investment, power. I think that's true. I think I've really struggled to see that you can build it, but you might end up with a data center which lacks power. And we've previously talked about this in California, where they have built these data centers, and now they're going to wait 5 years for them to be connected to the grid. Key components, shortage of memory chips, turbines, transformers, etc., memory chips in particular, and materials, copper, aluminium. So
it may be that actually investing in jet fuel is not a bad idea, because they're starting to power these things using jet engines.
Really? Wow.
Yeah. And apparently there's a shortage of jet engines now because everybody wants a jet turbine to power their data center. And so
yeah.
I
Jet
think
fuel is cheap, actually. Yeah. There you go. And so this is the price of a DRAM. Astonishing. They've doubled in the first quarter of 2026. And so AI is just bidding up for components. If you have this vast amount of investment going in, you're just raising the prices of all the inputs, electricity, copper, aluminium, and bigger, the new NVIDIA chips use more and more memory, which means memory demand is outstripping supply. So when we talk about AI cap expenditure, how much of that is just going on bidding up prices for components and going to profits elsewhere? I thought this was a great chart, though. This is like, let's put the relative popularity of ChatGPT in perspective. OpenAI is the grey line, and this is actually monthly spending on OnlyFans. So OpenAI.
What's OnlyFans?
OnlyFans is a porn site where I believe you So people like film themselves and get subscribers. But anyway, there you go. So, but AI disruption is real. Management are increasingly mentioning it in earnings call, so which is poor metric, frankly. Um, but on Richard's point, it's very difficult to forecast exactly how AI is going to disrupt the economy, and it will do so in unexpected ways. Now, this is a really interesting chart. This is the number of bank branches and bank tellers after the invention of the ATM in 1973. Now, in 1973, everyone was saying, right, so you're going to be able to get your cash out of a wall, so the number of bank tellers is going to collapse. That didn't happen. In fact, what happened was costs of running a bank branch fell, and it became more. So you built more bank branches, which meant that the number of tellers actually increased a lot. Marvelous.
And in fact, the number of bank tellers fell when automation, when I guess we started to move more and more towards cashless payment systems.
Exactly. That's exactly right. And online banking.
Yeah.
But also, this is I thought this was really interesting. And on Richard's point about skepticism about AI, if you get AI to answer a question for you and then you type in, "Are you sure?" more than half the time they will all change their minds. So, how reliable is AI? Question mark. So, bottom line, AI capex expenditure is making a huge contribution to US economic growth for now. It can't continue forever. And when you say that it's going to contribute 1.7% of GDP next year, is the power there to actually achieve that investment? Question mark. Any fall in US capex will be bad for the US economy. Okay, so once again, we're sort of overrunning. There's so much going on in the world. We end up talking about markets far much that it doesn't allow me to do all the sections I'd like. So we'll do another one next week, do more sections, and I've also got the copper special will be hopefully come out some stage next week. So our final section this week is on wind power energy REITs. So which have been a total and absolute disaster. As the rest of the market's been going up, their share price has been going down. They now yield dividend yield of 11% with a discount to NAV of approaching 40%, i.e. the market is deeply skeptical about the sustainability of those dividends. This is Greencoat. Again, dividend yield of 11%. Last October, the Department of Energy and Net Zero downgraded the expected UK wind power load factors. Now, when we talk about, how expensive UK energy is, we have been far too optimistic about how good wind energy is. So the load factor is the actual power generated by your wind turbine compared to its theoretical maximum, i.e. nameplate generation times 24 hours a day, times 365 days a year. So the Department of Energy and Net Zero had been forecasting offshore load factor of 61% and then onshore 48.7%. Very specific numbers, I think you'll see. They've then downgraded them enormously. That's like knocking a third off. So wind nowhere near as good as they expected. And the bottom line is that it's even worse than that. Actual data for offshore is 40%, onshore 26%. So although they've downgraded it, they're going to do some more downgrading at some stage when they start dealing with reality.
Does that include transformer and transportation losses as well?
No, no, none of that. And interestingly,
Oh, who's that on the left?
I know
Is that a clown?
it's Ed Miliband. I did this on ChatGPT, and I tried to do this
That's
last
clever.
year, and it didn't work. It was terrible. But suddenly, it's good. AI is coming
Okay.
on.
Do you have a
Yeah,
subscription, or you just do it?
yeah, it's
I don't
free.
have a subscription. I refuse to pay them anything.
I noticed it took about, a couple of minutes to generate, Richard. And as it was generating it, I was feeling guilty because I was thinking, you know, that's like taking a chainsaw to some small tree to
Yeah.
generate this cartoon.
Oh,
But anyway, uh, while the government's been, massively overly optimistic about the load factors for UK wind, the companies themselves have been reporting much lower wind factors. So, there's no excuse really for the UK government to have been so totally optimistic, overly optimistic about the load factors. And reminder, even with the load factors being what they are, we can't deal with all the electricity they actually generate. So we've been paying them to turn off when the wind gets too high and they generate too much electricity. You've seen this chart before, but hurrah, we win at something. Our electricity price was the highest in the world. And actually, well, as an aside, so when I saw that first cartoon, I thought, well, let's get ChatGPT to redraw the cartoon of Ed Miliband, but substitute balloons for wind turbines. And this is what it did. And I was really, really impressed. Not only did it substitute the balloons, but it kind of got what I was aiming at. And so it changed the background to solar. I just think, my God, this stuff actually is working now.
it's good, Keith.
Yeah. Okay. So quiz of the week three, Richard. Last quiz. Okay. So you've seen the load factor for onshore wind turbines was 26%. What was the load factor for UK solar farms? Go
So,
on.
are we saying that 100% is assuming the sun shines 24 hours a day?
We
Or
are.
we
Yeah,
are.
we are.
Okay, so in the UK, probably on average, the sun shines for about, on average, probably for about 2 hours a day. Let's call it 3 hours a day. So that'd be 1/8. That would be like 14, 13,
Okay.
30, 30, 12. And then you got a bit for dirty stuff and it being off 9%.
Actually very good. Answer 10.4.
Yes.
10.4. Very good. Yeah. So, you have to have a hell of a lot of this stuff at a 10% efficiency or like load factor to generate the electricity you need. And finally, inflation watch. So the next central bank meetings are in March, but going quickly through this, you see that inflation is coming down everywhere, or certainly did in January, mainly due to lower energy prices around the world. And so UK CPI 3%, still, way above the Bank of England's target, but due to come down towards target later in the year. US 2.4%, coming down again. EU 1.7%, core 2.2. Japan, really interesting. Japan now 1.7%. And China, deflationary forces still strong. Okay. Now, what I wanted to show you was this. So I think this is really important. Pause, have a read. What it's saying is, and this is what I've been banging on about for years, that aging populations are deflationary because old people don't spend anything. And the great thing about this blog post is that it actually provides the data. So saying when you hit 75, you stop traveling, you eat less, you go out a lot less, you buy less. So
Mm.
demand collapses. And who's making money? People with assets, old people. So this is why I think aging populations are deflationary, and hence why my friend is buying Japanese 30-year bonds. He thinks we're going to be back in deflation and Japan is going to be cutting interest rates and doing more QE. Finally, good news. So, thank you to Sahil from our Discord today, who said this is from the BBC. We are now generating geothermal, Richard, another expensive form of energy that we are,
Sounds good though, Keith. It's free.
it is.
Well,
Well,
it's not free.
have you been talking to Ed Miliband?
It's free, Keith. It's
Yeah.
like, I don't understand why there could be any doubt in your voice.
So, and good news is there's, a few more sites. There's enough, produce enough electricity to power 10,000 homes. And the great thing about geothermal is it's base load. It should be constant. So you don't need a, battery backup and a separate coal-fired power station to, provide power when the wind's not blowing, etc. And even better than that, so what you do is you pump water down into the earth, it heats up, but also it dissolves minerals, etc., down there. And so when it comes back up, you can extract lithium. So they're going to be extracting initially 100 tons of lithium a year, but then moving to 18,000 tons a year, they say. So there you go. All good news.
Fantastic. Just in time to coincide with the demise of the lithium battery for vehicles.
So concluding comment. Well, all change. Real big set. Richard had been absolutely dead right on this, actually, that there's been huge sector rotation, but as you've seen, equity markets have kept on marching higher. So software companies have down a third. Let me repeat that, a third in 3 months. But equity markets as a whole are up. And so investors are rotating out of tech and into hard assets, oil, copper, silver, gold. Um, and question mark, will Trump bomb Iran? Now, I've been talking about what I've been buying, and I find these charts just shocking. So this is Enquest, and I rotated out of copper, started buying it here. It's up 70% in 2 months, 3 months. I mean, these are shocking, shocking moves. Oil companies are moving. There's Harbour Energy and mining shares, they've not come down. They've kept on rising despite the fact that the copper price is down from its intraday peak where it shot up to 6.6 dollars a pound. There's essentially what I think is happening, and I'd be interested in what Richard's view is that basically the weight of money rotating out of tech into these smaller markets is moving share prices.
Yeah, but I think also that it's only just begun. I think that sort of, well, one of the things that Jeff Curry said yesterday, I listened to in the Macro Voice, he says basically he's a very interesting guy to listen. He says basically there are two investment themes. There's data or there's commodities. And the investment theme for the last 10, 15 years has been data. It's now moving to commodities. At some point, and prior to that, it was commodities, and at some point, so now it's moving to commodities, and at some point it'll probably move back to tech, data, tech.
Yeah.
And he's very much in the camp that now is the time for commodities. And if you look at the valuation of, I can't remember what the numbers are, but if you look at the valuation of all commodity producers as a percentage of the S&P 500 or the US stock market, it's some ridiculously low percentage level in comparison to what it historically has been.
Yeah.
And part of the problem, of course, has been these very low prices, and low prices result in under-exploration, underproduction. There has been manipulation of the prices, like the price of tin was manipulated for many years, and then the supplies ran out, which is why tin is the same with silver and gold. So all these assets are going to find their natural floor, which is a lot higher than where it was. And I think we're just in the initial phases of that, and some of these prices have gone up substantially. But I think once the price of oil starts to move, which I believe it will do at some point, then we're going to see that energy producers and energy service companies are going to do very, very well, I think.
Yeah. No, well, I agree. But what I found really interesting is that, the copper miners have kept on rising, even though, copper has stalled. And so it's, essentially investors are very optimistic about the future, and the decoupling, it's like equity markets in the underlying economy. It's the equities move despite, on their own, irrespective of the underlying.
Yeah, it's like that graph you showed, Keith, earlier of the average share price of US newspapers versus their earnings expectations, and how the market anticipated. Well, I think the opposite is happening now. I think the market is anticipating that commodity prices are going to go up, a lot of them. So
that's an excellent point, Richard. That's a very good point. Yes, absolutely. So
the other thing I would say, just generally, is that with these metals, copper, silver, and gold, and so forth, you really want to be in high grade stocks with high grade resources, because as energy prices go up, the cost of extraction is going to increase substantially. And if you're in a company that has a low grade source, their profitability, I think, is always going to be it's going to be more affected clearly by an increase in energy prices, which I think is going to happen, whereas a high grade is pretty much insulated from that.
Yeah, I agree. But also I've been doing this thing on copper, really interesting, and should also be looking for companies with a lot of tailings. And to know why, you'll have to watch the copper podcast coming out at some stage. But that's enough. Anyway, so loads going on in the world. We'll keep on overrunning, and next week we'll do it again so we can actually have some special sections. But thank you very much for watching, and in the meantime, thank you. It's goodbye from Richard Wheaton.
And it's goodbye from Keith Jordan. Goodbye.
Goodbye.
Full disclaimer. The material and information contained in this podcast is for information and entertainment purposes only, and should not be relied upon for making a business, legal, or any other decision. We may own or have a financial interest in any securities mentioned. Listeners should conduct their own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. Whilst we endeavour to ensure that the information presented on the show is correct, we make no representations or warranties of any kind, express or implied, with respect to the podcast and website, or to any information, products, services, or related graphics discussed or presented in the podcast or website. Any reliance you place on such material is strictly at your own risk. You are solely responsible for the investment decisions you make. We will not be responsible for any errors or omissions in the podcast or website, including in articles or postings, for hyperlinks embedded in messages, or for any results obtained from the use of such information. Nor will we be liable for any loss or damage, including consequential damages, if any, caused by a reader's reliance on any information provided by the podcast or website. Please do not listen to the podcast if you do not accept self-responsibility for your actions.